We are getting more third quarter earnings results from major U.S. banks. Charles Schwab reported a beat thanks to a surge in retail investing activity, and U.S. Bancorp beat on sales. But new worries about the health of regional banks are weighing on the major indices. Let's get our perspective now from Stephen Biggar, the Director of Financial Services Research at Argus Research. Stephen, thanks very much for joining us.
Hi, Roger.
Your thoughts, first of all, on Charles Schwab easily beating right now.
Yeah, this was a powerful quarter for Charles Schwab. I think the certainly the market tailwind helped quite a bit. Always helps when you have asset levels moving higher. That's also resulted in a lot greater client activity, a lot of trading volume, and interest rates being a little bit more favorable as well. So really a clean beat across the board, and favorable commentary about the future too.
Was there anything from Schwab that you saw that may have made you raise a question or two?
Well, not really. I mean, it's always the sustainability, I think, of this. You can't rely always on such favorable markets, and I think to the extent that if we are in a bubble, that could hurt. But they're saying the right things, and they're bringing in the right type of client and customer account. They, despite their size, still have very strong growth in accounts, which is also holds promise for the future as well, to keep to keep those assets growing as more people bring assets to the firm.
Yeah, the CEO today saying they'd added a lot of Gen Z clients, up to 1 million, I believe was the number.
Yeah, well, you think about the growth of clients. Of course, there's a fair amount of maturation among baby boomers and the older crowd. So you have they've been touting their collection of younger investors coming on board, and clearly the long-running bull market has attracted those clients, and really the type of what's working in the market today. You think about AI, you think about the social media stocks, or the Bitcoin, cryptocurrencies and the like. So that's bringing in a younger crowd. But typically when you have long people that just don't know anything about downturns in markets, you get some nice attraction, I think, in particular of the younger generation, and great to have those clients for a lifetime, rather than capturing in their 40s and 50s. So to the extent they can bring on people in the 20s and 30s and make them lifelong clients, it's a powerful narrative, for Schwab's future.
Now, you mentioned Schwab was bringing on crypto, I believe, for next year. How important is that? I know for older generations, they're shying away from it or cautious about it. Is that the case for Gen Z?
Well, you have to have a long-term view. Clearly, I mean, I think the same conversation is happening, say, with the availability of private market investments, private equities and private credit into the market, into, say, 401k plans. There's a big push by a number of firms to do that. And I think it's the same thing. You have to have a long time horizon for these things. They do, they're much more volatile potentially. They're much less liquid potentially. And if you don't have a multi-decade type of time horizon, this is not the thing for 60, 70-year-olds necessarily to bank on, to be there. There could be a downturn that just doesn't recover. So if you, I think, played right, and if you don't make it some outsized performance portion rather of your portfolio, these can be good investments over the intermediate and long term. But I think, yeah, Schwab is right to to look to cater some of those investments to the right demographic.
And overall, the banks, is this the time to look at them, or should people be stepping back?
Well, banks are having a terrific third quarter earnings season. No doubt. We've had a lot of the beat relative to consensus has been in the capital markets area, so investment banking, and that includes whether it's initial public offering activity or merger and acquisition advisory fees have been quite strong. Trading environment also was a pretty volatile third quarter. Seasonally, typically you have a slowdown in the summer months. Third quarter includes July and August, but this time we just had very strong trading revenues, and that's a lot of repositioning trades. We have big moves in interest rates, big moves in commodities. We had big moves in fixed and income and in equities. So that's how much of that is will continue. It seems like all year we've had that, but I do think on the investment banking side, capital markets generally, that this rebound is durable. The tailwinds that are favoring this continuing. We have record high equity prices. That certainly helps with attracting private companies to go public. It helps existing public companies to issue more equities. Lower interest rates help to encourage more issuance of debt. You've got this bit of flywheel effect going on with that. So I think as more companies do go public and are successful, it will attract more companies in. So this does feel like after some fits and starts over the last few years, that we have a more durable rebound in play here for capital markets.
And anything that could soften it right now? Just one last question before we go.
Well, there's always the geopolitical. There's always upsets on tariffs and trade policy. That's certainly through the banks for a bit of whiplash back in April, and it softened activity in the second quarter. So to the extent that those are sort of black swan events that could result in people just pulling back and rethinking where they are. But I think companies have managed through this call it tariff crisis for 6 months now. They're finding ways around it. They're finding that they can and should still look for opportunities to grow rather than pull back. So I think you never know kind of what that next shoe is really to drop. But again, I think this rebound has some legs to it. And companies will find a way and are out there issuing debt. They're expanding in certain areas. They're spending a lot on technology to get efficiencies there. And all that does bode well for the bank earnings going forward.
Okay, Stephen, thank you very much for joining us today. We appreciate it.
Thank you.
Stephen Biggar, Director of Financial Services Research at Argus Research.